Good afternoon, everyone. In today's video, we're going to take a look at 0 days to expiration options inside of the SPX market. In particular, the question I'm looking to answer is how fast do these 0 days to expiration options move, and what are some tips for those of you looking to trade these particular options? Now, this video is broken down into two different parts. In the first part, I'm going to break down the actual setup so we can set the scene and understand, well, what are we comparing? The setup takes place inside of the ES futures market, and we're going to translate that to SPX. That will then take us to the second part of this video, in which we're looking at the actual SPX options pricing, but instead of just one strike in particular, we're going to look at the at-the-monies, along with 2 strikes in the money and 2 strikes out of the money to see how did those options move over the course of this setup. There will be 6 points in time that we're using to study what happens to the pricing, and we'll compare and contrast as we go through this exercise. Now let's get into the first part of this video, which is talking about the actual setup. Now the setup is our fade setup as part of the futures volatility box. Here I have the ES futures market. In the course of that 9 to 10 a.m. Pacific hour, we had priced action sell off and breach our volatility box entry lines. Now the setup is quite easy to understand. There's only a few components. The first is we're looking for this volatility box breach, which takes place with this red candle right here. So when we have the breach, that's our first sign that, hey, we have our volatility edge. We're waiting for the edge signal confirmation. That comes with this green arrow right here, which tells us that, hey, we're officially now in oversold territory. That takes us to number 3, which is we're looking for a retest of our sign entry lines for our actual entry price. Now we get all of those pieces met inside of this particular instance inside of ES. And if we translate this to numbers, here are the 6 points in time that I'm going to be studying. The first is when we have our very first volatility box breach. The second point that I'll be studying the pricing at is what happens when we get our retest. The question I'm looking to answer here is how much better of options pricing do we get by waiting a little bit longer, getting closer and closer towards the tail end of the day. Now, point number 3 is when we hit our first target, which is this green candle right here in that wick. Point number 4 is your hypothetical best. What happens if you had timed the top perfectly? Point number 5 is what happened if you did not get out at that target, but you instead had to hold all the way down to where price returned back to the actual underlying price to where we were at, but you would imagine the options pricing is much different. And point 6 is what happens when we're officially underwater and we've hit out what would have been the stop had you not gotten out of any of these moves in the first place. I'm hoping this gives us a broad spectrum of pricing so we can see what this price look like when price actually moves in our direction, goes against us, but just returning to what you would expect to be break even, and then what happens in that quote-unquote worst case scenario as you get closer towards the end of the day and now price is moving against you. So if we take the same image, I'm going to sum it up a little bit smaller, but now I'll show you the table of the SPX options pricing. Now the way to read this table is to start at the money first, and then we can work our way up and we can work our way down. I'll go from left to right. So we have our at the money option, which was the 48.80 strike. This is again the calls, the 48.80 call. And at point number 1, which is when we have that volatility box breach, these options were going for about $700 per contract, $695. If we compare the contract pricing across the 5 different contracts we have, we can see that the 2 strike in the money varies from $12.70 per contract, so more than $1,000 per contract, to $310 if you went to 2 strikes out of the money. So that's the first thing, is the variety in pricing. The at the money's going for right around $700. You could get as expensive as nearly $1,300, and you can get as cheap, at least on this table, as right around $300. Now we have the retest, which is point number 2. So let's continue to see what happens as we come down to point number 2. Now, using logic, point number 2 is that same price, but this time more time has elapsed as we come back down, and you would expect the pricing to be a little bit more in your favor for the same contract. And that's what happens here. With that same 48.80 strike, which was $6.95 at point number 1, that has now dropped by about 9% to $6.30 by simply waiting for that edge signal and waiting for the retest of the sign entry line. So here you can see patience is key, and you can also see how that pricing varies in terms of the quote-unquote discount you get as you go further and further out of the money. So if you were to wait for this retest, then the out of the monies become even cheaper. If you don't want to wait for a retest, then you're better off trying to go closer to the in the monies, as you're going to see the options pricing move a little bit less if you were to get that retest. So that's the first little takeaway for all of the futures volatility box traders. It's knowing which strike to choose based off of what your trading style is and where you're taking the entry. Whether it's that initial breach with the edge signal or whether it's waiting for the retest. Now we move on to point number 3, which is when we hit the first target. Now, as expected, we see a nice bump in pricing, and this pricing is of course skewed because you are trading a very risky asset with the 0 days to expiration. Now with the in the money options, we see the pricing move, and this is using point 2 as our entry. We see the price improves by about 25%. The at the money is about 27%. The 2 strikes out of the monies, you have of course the most profit at a plus 38%, but you would also expect these to be the riskiest out of these 5 contracts that we're looking at. Now we move on to point 4, which is if you had tagged the very best of the best, the top portion of the entire move. And there we can see that the in the monies still have a pretty handsome return of 56%, but that goes all the way up to 89% with the 2 strikes out of the money. So far what we're seeing is the lottery contracts, the 2 strike out of the money ones, have the highest percentage gain as we come towards the tippy top, and this lines up with what you would expect. However, the real effect of why I think you'd want to be cautious of these 2 out of the money strike options is when you get to point 5 and point 6, you can see the effects. So now if we come to point 5, which is simply just a return back to essentially break even of where that move started from, you can see all 5 contracts are now underwater. The in the monies are holding on to their value a little bit better, minus 5%, compared to the at the money at minus 8%. But that 2 strike out of the money, you can see the decay already kicking in, minus 16%, starting to move against you pretty dang quickly. Now, as soon as you get to point number 6, you can see that the 2 strike out of the money options are getting pretty close to worthless, minus 70% nearly across the board for the out of the money options, and even the at the money and the in the money options are now starting to lose their value fairly quickly. If you were to use something like a plus or minus 40%, the in the monies would have hit your target only in this move from point 3 to point 4, but would have hit your stop much quicker in this point 6 move right down here. So that again highlights to me, and we've talked about this exercise before, why if you are trading 0 days to expiration options, timing is really all that matters here. If you're ignoring timing, then adding even 1 days to expiration for your options buys you a little bit more cushion to not have to face these sorts of theta decays going directly head on against you, but instead you have the luxury of just a little bit more time, even if it is for a day trade. So hopefully through today's video, you get another data point to add to the bunch in the previous options exercises we've done, comparing SPY versus SPX versus ES futures to understand which asset class works best for you and your particular trading style. Take care, everyone. Good luck trading, and I'll see you in our next update.